Hello guys, I'm back again. So I'll be talking about the price earnings growth ratio, popularly being called as the PEG ratio, and I'll be discussing the impact of three most important variables upon this PEG ratio. The interest rates, number two is the risk, and number three is the growth. So what's the formula for the price earnings growth ratio? In price earnings growth ratio, we tend to take into consideration the price to earning in the numerator and the earnings growth rate of EPS in the denominator. Right, so price to earning in the numerator and the earning growth of the company being denoted by your EPS in your denominator. Again, it's a very good valuation ratio. People tend to use it to judge their undervaluations or the overvaluation for a particular corporate. Same logic as a price to earning ratio. But again, we need to understand the relationship. The relationship is like when we talk about the interest rates, again, it has an inverse relationship with the interest rates. When the rates of interest are falling, the PEG ratio might rise, and when the rate of interest are rising, the PEG ratio might fall. Right? Again, the same logic as the price to earning ratio. But again, here the expectation and the sentiment also matters, right? Because currently we can see the PEG ratios of the company very high because the expectation is the interest rates will fall down, and the vice versa is always there, right? The second metric which affects the PEG ratio is nothing but your risk. When the risk in the economy is higher, again the PEG ratio might be lower, and when the risk in the economy is lower, the PEG ratio might be higher. Right? And might word is very important here because it doesn't always signal the same relationship. In more than 60% or 70% of the scenarios, it will signal this definite relationship, but there can be some other nuances or some odd scenarios in which this relationship might not always work. So we always need to just open our eyes, ears and mind to try to understand this relationship from a practical concept or perspective. The third is growth. So like when we talked about the price to earning ratio, it had a positive relationship with growth, right? When the growth rate is rising, the price to earning ratio is also rising. Again, the PEG ratio also has the similar case, but there is some nuance. Why? Because initially when the growth is rising, the PEG ratio also rises. But there is a certain point when the PEG ratio starts to fall. Historically, we have always seen an inverse U-shaped relationship of the PEG ratio with growth. When the growth is rising, the PEG ratio would rise up to a certain point, and some point will come when the PEG ratio will start to fall at an increasing growth rate as well. Right? So that is something we need to understand, and that has also been seen in majority of the companies. Right? So that is one thing. And again, I told you about the price to earning ratio, price being a leading indicator and earnings being a lagging indicator. So that EPS component that you have in your denominator is again a lagging indicator, and that we need to justify and understand.